Today we're going to be talking about the basic market maker template. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Beginning of the week, we had some fantastic trades last week on the British pound crosses, as well as a lot of the other US dollar crosses and other major pairs. I've got a lot of traders messaging me and sending me screenshots from some of their trades on all different instruments, putting the pieces together, high of day, low of day, the timings, the 12 candle window, the bigger picture structure. Today we're going to talk about the basic market maker template. Just an overview. Last week we had some pairs that were literally textbook perfect examples of the market maker template for the up pattern and then the down reversal on the Friday. But just to reinforce, there's nothing new under the sun. We're going to see the same things over and over and over again. We're going to talk a little bit more today about average daily range, average weekly range, and median price, how we can use median price in terms of our round numbers, if we're not at round numbers, to be identifying how they're trapping traders around a middle price range, and then expanding the range, hitting both sides before shifting the market for a larger trending move. But just coming back to what we are going to talk about today, the basic market maker template. One of the most common patterns that we're going to see is the market making 3 days of rise. It could be a Monday, Tuesday, Wednesday. It might be a Tuesday, Wednesday, Thursday. It could be a Friday, Monday, Tuesday. But typically Friday, Monday is the days where we will see the markets typically reverse. And if you sort of just step back and think of it in common sense, they end the week, they lock in their profits or they lock their book, and they begin the second week with a new agenda. Now that said, we can always have continuation 2-week trends. We could have back-to-back continuations of trades. But the big picture is basically simply this. We will get a market that will consolidate, put a peak formation in, taking out a low or a high of the week. And in this particular case, because we're using the up template, we're going to use the low of the week as an example. The market will consolidate, and we talk about round numbers, specifically 50s and zeros. After Friday, on Saturday morning, I must have received 10 emails right away about trades coming off of 50 and double zeros for measured moves in that US session. So just to reinforce, we're always trading inside of a box. We talked about that on our last video. And when they consolidate the volume inside, just think about what's happening. They're getting traders caught into these contractive ranges. And as the market consolidates volume and then expands, it hits the stops, expanding the range, trapping traders even chasing the expansions of the range before finally moving and shifting for 50 or more pips and possibly 50 up, 25 down for 50 continuation before they hit their average daily range and then consolidate into the next session. So if we were in an up template, we might see, for example, a Friday, Monday reversal, and I've talked about using Friday, the peak formation, and if Monday's inside but it expands it, that could be our geometrical rectangle for a measured move. If the market may only do a half of that range before we see this whipsawing on that level 3. Some traders asked, what is level 3? So we're talking about the first day that the market starts and it takes out a previous swing high before the peak formation low. So the last high before the low. If we were in an up template and the market reversed and took out that last high before the low, we would now be in level 1. So we'll call that level 1. The market pulls back, goes into consolidation before breaking higher, going into level 2 move. So the easiest way that I interpret this, and I think this is consistent almost week in and week out, day 1 is level 1, day 2 is level 2. Now sometimes we'll see that happen maybe later in the US session, but typically day 1 is level 1 to me. Day 2, level 2. If day 2 is a trend trade, these are the days where typically most trend trading systems in level 2, traders will have EMA trades, maybe swing trades with stochastics or momentum, RSI, those sorts of things, because level 2 continues the trend. Even with a stop hunt, often that may be a dip down into the stochastics or indicator for the dip for the buy signal before we head up to level 3. Level 3 typically will have trading occur taking out stops on both sides. So the market at level 3 will typically blow off in the direction of the trend. So it gets traders chasing the move, thinking this thing's going to go, it's going to be a big move, and because also the indicators are all supporting that, trend lines, all that, and they will follow this trend up only to find out that they're buying at the end of the move. The market pulls down and hits stops at the low of the day, and then typically we will see another break of that low after the peak formation, maybe into Thursday or even in the same session on level 3. A great example of that is when the Fed has their monthly announcement, the FOMC. Typically we will always see a level 3 type situation after the Fed. So level 3 we'll see whipsawing on both directions, and like Paul Tudor Jones said, whether it's end of day, 15-minute, when you're in level 3, that's the hardest area to trade because it typically will move aggressively back and forth. So traders might chase this move and be up 25. It comes back and stops them out for a 50 pip move down. It goes back up and stops out traders that were short, pulls back down, gets traders that were long, and goes sideways. So it's can be a challenging level to trade unless you see that possibly is in place and you're prepared to exit as that trade is peaking out or reversing. So we have day 1, level 1, day 2, level 2, day 3, level 3. Day 4, or level 4, typically will be a consolidation or one last attempt to eat into supply, or if it was a down market, to eat into that last little bit of demand. We get our double top formation inside of a peak formation. We may even get consolidation, but typically when we get the consolidation for a level 1 reversal, it will be underneath of the range, and this market has all that long volume trapped above where that consolidation will shift. We had an example of this on Friday when the market goes into a level 1 straightaway or a trend trade. These are the trades that typically will not come back. So traders are looking to trade the stop hunt back into the range, and it never does that. It just keeps dragging lower, pulls back a little bit, drags lower, and it keeps dragging all day, trapping traders, counter trending the move, and just keeps dragging lower, possibly even into the close. And if you think about what's happening, they've got these traders who were caught long, possibly holding on to those long positions, maybe lifted their stop, maybe they've averaged into the losing trade on the downside, and again, if we flip this, it would be the same thing for the down move, but this market will drag lower and in most cases close pretty much right back where we started the week, fulfilling its average weekly range, its average daily range, and basically opening and closing with no change for the whole week. If you understand that, how silly that whole thing is, opening and closing at the same price almost, give or take 25 to 50 pips, but they've moved at maybe 250, 300 pips over the course of the week. So we have our 50 pips a day minimum because the average daily range is usually 100, 150 pips on most of these British pound crosses. So if we flip this around, we would have the same thing for the down market. Now, this market doesn't necessarily have to go up. We could have a market that comes down and does a Tuesday, Wednesday, Thursday, and a Friday. It could be a big rectangle and still have 3 days of buying power, or the same if it was a down market. But there's an organized design to how the market trades each week. And as I said last week, we had some textbook perfect examples. We're going to look at those. But again, I just want to hit home each day. We talk about our simple system. Structure. Are we in a rectangle? Is there a larger geometric shape, a head and shoulders, a double top, something where we've got maybe a multi-time frame geometrical structure for a measured move? When this market broke down from that lower double top consolidation, we had a 100 pip move down on some of the pairs, and those trades don't come back. Now, if this market was going to stall, which we saw a few weeks ago, we could see this come out of a level 3, and it might drop down, and it could actually go 3 pushes and fail and reverse, and we could get a reset. So we could get a peak formation reset for a continuation on a Thursday, Friday, going back in the original direction. But typically, day 1, day 2, day 3 sets up how that market may trade towards the end of the week. And I've talked about this before. Sometimes the best trades come at the end of the week. They know that a lot of retail traders can't wait to get started on Monday morning. They've been studying hard all week. They've got the emotion and the elation and depression out of their system from either winning or losing trades, and they come to the screen ready to trade on Monday morning, and they know that. And sometimes there's some fantastic trades in the first part of the week. But often, as we saw Friday, some of these traders that might have been long on Monday took nothing off the table, and they ended up with nothing because the market came right back down. They sit and watch in disbelief as the market goes right back down to their fill price. And they exit the week and they go, how stupid could I have been? I took off a big profit up at the top. We call that, or I call that, around the world trade, because it goes all the way right back to where we started. So one of the things we talked about over and over again is taking a profit. I had to learn the hard way, being in so many winning trades and not taking profits off the table because I wanted more or I thought it was going to move further. But as you know, you've been following these long enough, even when you get it right, other than the straightaway day, they come back to get you even at break even in most cases. They like to finish the week with not very many people taking very much off the table. So we talk about structure, we talk about the high and the low of the day, okay? And again, we talk about that expanding, but we also talk about identifying the true highs and true lows. Where's the real box? Where's the 50 or 100 pip box that we're trading in? I am reinforce this over and over and over again. 50s and double zeros, those are the boxes. When we get quarter expansions, they're either pullbacks or an extended stop hunt, but the boxes typically will be 50 and 100 pips. 0 to 50, 50 to 0. Timings, the 12 candle window. Again, that narrows our focus down to the highest probability time frames of when these markets will conduct a stop hunt, a trap, and a trade. And like clockwork, 90% of the time, we may get the stop hunt in that 7-1-7 time frame, the 1 hour before that 12 candle window, 7 p.m., 1 a.m., and 7 a.m. New York Eastern Standard Time, where we see the high or the low taken out with a 1, 2, 3 before reversing, and then heading into the 12 candle window. The trade has already been set. You just need to position yourself, or I position myself in the market, pin hammer at numbers for the measured move, or to the move back to the other extreme where the previous trade may have started. London low, London high, whatever that may be. Engulfments and pin hammers. Great question. Somebody asked me, where did the term pin hammer come from? To me, a pin bar has usually got a really long tail and a tiny little body. A pin hammer is a bar that can have a bit longer tail and a bit fuller body. So it may not, we could call it a pin bar. I just use the term pin hammer because typically we'll see a pin hammer after the engulfment, and that pin is the stop hunt into the trader who's already in the market, who's got the direction right. That's one little last gasp at them to get their cash or get them out at break even. So pin hammers and engulfments, usually at or near the numbers. For the 50 pip boxes, if they're continuations or extended stop hunts, we could see a quarter level there. But I use a 1 bar stop, and typically I'll be shooting for 50 pips or more, unless it stalls at the high or the low and consolidates, which could be 40 pips, but typically we'll target 50 pips. Most important components is managing yourself, staying emotionally orientated. There's plenty of trades. You do not have to do the wrong thing. Focus on doing the right things and just executing your trading plan flawlessly as possible. Number one is risk management, self-management, and trade management. And most of these trades, the only management that I need to do is either moving my stop loss to break even at 30, 35 pips. If these are the right trades, they typically move quickly. I gave my rules out for how I manage it based on time decay, but also these trades don't need to be moved to break even when they're right until it's moved 70-80% of the way. And then if it goes 40 pips, I'll be paying very close attention to how long it trades near my target. If I'm at a high or a low or double zeros or a 50, because I may typically look, if it struggles to go through to that 50 pip target level, of exiting the trade with at least 40 pips. So hopefully you got some value from that today, traders. We're going to look at some examples on the charts from last week. But again, consolidation, expansion, stop hunt, trap trade, shift the market, trap traders up high, shift it, drag them down lower, stop them out, margin out their accounts, average daily range. Okay, pay attention to that. How many pips have we moved today when we go to the session? What's our average weekly range? When we're up at level 3, have we already met or exceeded our average weekly range? And median price. If we're not at double zeros or round numbers, if we're at a quarter level, we may be at a median price where the market is jamming in the middle to hit stops on the outsides of those dealing areas for a 50 or double zero trade setup. So hopefully that makes sense. We're going to look at some examples now on the screen. Have a great trading week. Keep it simple, traders. Every week, just focus on 1% better. Stay disciplined. How good can we get? And have a great day. May the markets go with you.
Good day, traders. Stacey, Burke, continuing our discussion on the basic market maker template. Just looking at the pound Aussie from last week. We have the pink line is our divider between Friday, Monday. Monday opens up inside of Friday's range. And we have a low taken out on Tuesday. And Monday's high remains the upper boundary. And as I talked about, there are subtle variations of how that up template, down template will play out. And here's an example of a market in a sideways consolidation. They conduct a stop hunt to the high on Tuesday and then stop hunt to the low. When they come off the low, they take out the last swing high before the low for a level 1 reversal. So day 1 was Monday, day 2, but we have a Friday, Monday, Tuesday geometrical structure now. Monday's high, Friday's low. The market broke out and pulled back inside, came back down, and the market then took out the high on Wednesday. Wednesday, typically day 3, midweek reversal, but we don't have our normal sort of 1, 2, 3 setup here, but the market jams traders in level 1, level 2, and then we get the 1, 2, 3 on Thursday in that upper level, trapping traders, chasing that move into the last bursts up through the high, up to the high. We have our peak formations forming above 75. And we talked about double zero and 50 pip boxes. So if our box is 50 pips and we come back down to 80, 50 on Friday, the market conducts one more stop hunt, one more grab at traders that have shorted it in the US session on Thursday before consolidating underneath of 50 and then dropping down towards Tuesday's long traders in the US session. We're not there yet, but at this stage we could be definitely heading down towards getting the money on traders who may not have taken any profit off the table. But again, coming back to the template, Friday was down. We consolidated inside on Monday, inside day. They hit the high, trapping inside bar traders and then hitting the stops down low and starting the count. 1 push, 2 push, 1, 2, 3 for a level 3 before reversing and consolidating underneath the low of the day. So they hit the high of the day as well as the low of the day, and then they drop down inside underneath of the low after 3 legs of up movement, stop hunting back up into the shorts, consolidating and shifting the market away. Pound New Zealand, similar. We had Monday's high inside of Friday's range. Friday's low was taken out. So Monday's low becomes the new low. So we have our high of the week and we have the low of the week. And then on Tuesday, we come down and they stop hunt the low of the week. And they come up, taking out the swing highs from the London session. So Monday could be the end of Monday into Tuesday morning, level 1. They drop it down. We start the count again. Level 1, level 2, and then a 1, 2, 3 inside of the peak formation. Could even say 1, 2, 3 in Asia inside of the peak formation before dragging away. So again, a different variation, but the same goal, the same objective was applied. Drag traders up high, shift the market away, consolidate it, get them to chase the swings long again, and then drop it down, go into consolidation. All of this volume above 25 is trapped. If they're holding on to that, hopefully they're not. One more grab at traders who were short before dropping down and dragging further away. No chance really to get in for traders chasing the move unless they got in the U.S. session, and hard for traders to get out if they're in profit because they're not sure if this is going to turn around. It just keeps sort of dragging slower down, down, down. But again, the 1 push, 2 push, 3 pushes up, dropping down, and 1, 2, 3 again, getting traders to chase that long move before dropping it away. Pound Canadian, a little bit more obvious to see on this pair. Monday, Tuesday, inside of Friday's anchor point highs and lows. Stop hunt down into traders who were long on Monday before reversing back up, putting in a peak formation, and again the classic level 3, dropping it down below the low of the day after breaking in the direction of the trend. So uptrend, the market blows off in the direction of the trend, but it pulls up above and consolidates on top of the peak formation low, but it actually consolidates underneath the peak formation high as well. So one last stop hunt up into traders who were short before consolidating in a 25 pip box and then dropping down and dragging away. So again, take traders up high, get them to chase the move, big strong momentum, that triggers all the technicals. So if you look at the momentum driving these trends, this would get every technical system going long. And then on Thursday, the same thing. It gets swing traders into the trades before consolidating and then dropping away. The pound, again, great example here. Day 1, level 1. Day 2, level 2. Day 3, we get the peak formation blow off and dropping down. One more retest at the high, and then again taking out the low, and then consolidating in a 50 pip range on Thursday into Friday morning. Consolidating it even tighter in heading into the Europe Open into a 25 pip box, and then dropping it away and closing below where we opened. But great example. Day 1, level 1. Day 2, level 2. Day 3, level 3. And again, heading into Monday, that was a really strong downtrend. But they flipped the book Monday, reversed the trend, take out the last high before the low. So we're level 1. Level 1, day 1. Level 2, day 2. Level 3, day 3. Pound yen, similar. Again, just a subtle variation. Reversing Friday's downward move, a mirror image essentially of Friday's trade before Tuesday, putting in 3 pushes, 1 burst, 2 burst, 3 pushes to the peak, and dropping down and taking out the low. So an example of where we get day 1, day 2 has all 3 levels and consolidates into Wednesday, Thursday. Wednesday, Thursday is basically all one big inside bar, and then dropping away on Friday, away from all the trap volume that's up top, chasing the long move. Pound Swiss, another good example. Friday's high, Monday's low. They flipped the book. Friday's high remains intact pretty much as the upper boundary for the entire week. We get day 1, level 1 on Monday. Day 2, level 2. Day 3, 1 push, 2 pushes, 3 pushes into the peak before dropping down, consolidating underneath the low of the day. One more stop hunt into traders who were short on Wednesday's U.S. session before dropping down and consolidating underneath of the peak formation with 3 pushes, 1 push, 2 push, 3 pushes into the Europe Open, and then dropping down and pulling away on all the trap volume that's up top above that 1775 level. So we have basically 75 pips of traders chasing the long move, chasing it one more time before they drop it away and drag traders further into margin or stopping them out. So hopefully you got some value out of today's video, traders. The same thing applies for the down templates. And you're going to see subtle variations of all of those. But essentially, remember, they need to get people chasing the moves in order to trap them away from the true direction that they want to move the market. And some of those best trade setups come at the end of the week. Have a great trading week. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.